Well, happy Monday. Hopefully, you all had a glorious Monday and you weren't rudely woken up with an hour less of sleep today. Hopefully, you're prepared. You went to bed an hour earlier than you normally would have last night and made up for that hour. But yes, it is daylight savings. This is the first Monday. The first day was Sunday. This is the first Monday. Hopefully, they could pass some laws to prevent the time changing ever again. With that being said, we're going to be talking about a an issue that reminds me of 2008, and I don't exactly have all the details, so I'm going to be probably speculating a good amount of it. But we're going to go to Reuters, or however you want to say it. As soon as I get it back up, it's not what I wanted. I wanted this one right here. But anyways, yeah. So we're back to here. Explain what caused the Silicon Valley Bank's failure. In simple terms, oversimplifying it from what I could gather, poor business decisions, bank followed by a bank run, followed by liquidations of U.S. Treasury bonds before the maturity date, taking a significant loss that tanked the bank. So it's those three key areas: risky investments, bank run, and liquidating bonds at a loss to make sure that the bank run could officially happen. Let's see here, New York, March 10, Reuters, the SVB Financial Group, SVB.O, shut down and take over by banking regulators on Friday can be traced to the U.S. Federal Reserve raising interest rates and souring the risk appetite of investors. Here's a sequence of events that led to the Silicon Bank failure. Does that go to another one? Does that go to the same one? Yeah, it goes to the same one. Interesting. Global. Oh, that's global markets. Let's see here. What is that one? I think it's pretty much the same one. Ish. Who knows? Who cares? I'm going with this one. The Federal Reserve have been raising interest rates from their record low levels since last year in a bid to fight inflation. Investors have less appetite for risk when it comes to money available to them when it becomes expensive due to higher rates. This weighed on technology startups, primary clients of Silicon Valley Bank, because it made their investors more risk averse. Some Silicon Valley Bank clients face cash crunch as higher interest rates caused the market for initial public offerings to shut down for many startup companies and made private fundraising more costly. Some Silicon Valley Bank clients started pulling money out to meet their liquidity needs. This communicated in a Silicon Valley Bank looking for ways this week to meet its customers' withdrawals. Silicon Valley Bank sells bonds portfolio at a loss. To fund the redemption, Silicon Valley Bank sold on Wednesday 21 billion bond portfolio consisting mostly of U.S. Treasury. The portfolio. One of these days I'll learn how to speak. Today's not going to be that day. The portfolio was yielding an average 1.79%, far below the current 10-year Treasury yield around 3.9. This forced SVB to recognize a 1.8 billion loss, which it needed to fill through capital raise. Let's see here. Biden promises whatever is needed for U.S. banking system as SVB Shock hammer stocks. Yeah, it was not a good day for bank stocks today. You can almost say bank stocks were on a sale. U.S. bank collapse sparks fresh oversight fight in divided Congress. The Democrats want more control. The GOP wants the inflation to be lowered, so interest rates could be lowered. Morgan Stanley, BlackRock funds among those exposed to regional bank failures. Silicon Valley Bank parent CEO, CFO are sued by shareholders for fraud. What exactly say fraud? I think they were trying to invest. They're trying to raise their portfolios, and unfortunately, there's some companies that went bellied up and needed to be liquidated. Hence the run on the bank, or a bank run. Let's see here. On SVB announced on Tuesday it would sell $2.25 billion in common equity and preferred convertible stocks to fill funding hole. Its shares ended trading on that day down 60% as investors fretted that the deposit withdrawals may push to raise even more capital. So this is the issue: is when you lend out money, you don't have anything backing by it, and the lender or the lendee, because I guess the bank would be the lender, the customer or a startup would be the lendee, is not able to not repurchase, but pay off the loan, then that would be a loss for the company. This is the risk that any bank has or lending company has, is how much of your money can you actually risk to lenders? And I know there's the Frank Dobbs that said more than 75%, it's either 50% or 75%, you cannot lend out, or something to that nature. I don't know, it's really interesting, this whole story. I'm getting 2008 vibes, but hopefully I'm wrong. Hopefully I'm wrong there. Hopefully I'm wrong. Mainly because there's going to be a lot of people that are going to be doing a bank run because they see this as the beginning of something that may not be, which would be a self-induced prophecy. Some SVB clients pulled out their money from the bank on the advice of venture capital firms such as Peter Thiel Future Fund. Reuters reported this spooked investors such as General Atlantic that SVB had lined up for stock sales, and the capital raising efforts collapsed late Thursday. SVB goes into receivership. Not really sure what that means. SVB scrambled on Friday to find an alternative funding, including through the sale of the company. Later that day, however, the Federal Deposit Insurance Corporation, FDIC, then announced that FVB was shut down and placed under receivership. The FDIC added that it would seek to sell SVB assets, and the future dividend payments will be made to uninsured depositors. So that's pretty much what happened to Silicon Valley Bank. It's just it over leveraged itself. Charles Schwab, which is one of those major companies, is down 21.29% from the time that this screenshot was taken. So it's down $12.50. I don't think Charles Schwab is going to fail. They are very diverse. And then, of course, we have this one from the ArcCast. SVB had no head of risk assessments for 9 months before its collapse, as woke boss for Europe, Middle East, and Africa was busy organizing a month-long Pride campaign and a Lesbian Visibility Day. It seems like they had some risk assessment. Then, of course, you have this one right here. It may be worth noting that the Fed has the exact same asset liability problem that SVB did. While I understand their point, but the issue is where we go up. The same asset that tanked Silicon Valley Bank only tanked it because they had to sell at a loss. Like to fund the redemptions, the Silicon Valley Bank sold on Wednesday 21 billion bond portfolio consisted mostly of U.S. Treasury. The portfolio was yielding an average 1.79, far below the current 10-year yield around 3.9%. This forced Silicon Valley Bank to recognize a 1.8 billion loss, which needed to fill through the capital raise. So they were forced to sell their bonds at a loss in order for them to honor their commitments to their customers that were doing a bank run. So it was a bank run that really caused this bank to collapse, mixed with their more riskier lending practices for tech startups. And so yeah, I mean, it was poor decisions. And then, of course, I don't know what this really means going forward. It just seems like this could have been isolated to one bank, but unfortunately, when the news breaks that a bank has failed, it's going to cause a bank run. And I'm hoping people are smart enough to know that this is only two banks that have failed. I forget what the other one is because I didn't look into it. But this one's the main one that's failed. Another one that's failed. But there's only two banks. Now, if a third and a fourth one failed, it's probably going to be to a bank run and them not having liquidity on hand. But there's ways to mitigate that. If you're Wells Fargo or Bank of America or Charles Schwab or whatever, you're going to have a very diverse portfolio that could weather a bank run. And I think that's kind of what Frank Dobbs was trying to prevent, is that a bank run wouldn't liquidate the whole bank. But when everyone wants their money, that creates a bank run scenario, which causes branches to have no cash on hand because branches don't have all the money that the bank has. But I think we're going to be okay. Assuming that nobody panics. Hopefully this isn't like a COVID panic. Hopefully this isn't the toilet paper run of 2020 to where everyone panics and buys so much toilet paper there's not enough supply for the demand. But I think if people were just necessarily ignore it, it should be on your radar along with other banks. But I think we'll be fine. I mean, I survived 2008. I survived all the other crashes. I mean, we survived the Carter years, and we could survive this. I don't know what Congress is going to play at this. They may ask for more regulation, which I'm for limited regulation. You shouldn't be so regulated that you can't give out loans because you can't grow your bank that way because banks make money off of loans. But hopefully it's just those two banks, and hopefully nobody goes for a bank run. I'm pretty sure repeating myself many times because it's really important. That being said, that is my video for today. Let me know what your thoughts are in the comments down below. But most importantly, have yourself a wonderful day, morning, or evening.